Welcome to Mad Money. Welcome to Cramerica! My friends, I'm just trying to make a little bit of money. My job is not just to entertain, but to educate, do some teaching here. So call me 1-800-743-CNBC or tweet me Jim Cramer. When you have stocks with market capitalizations that are larger than some countries' GDPs, you can't ignore them. You have to handicap them. They're behemoths that deserve in-depth consideration before they report, but only to keep them on your radar screen. So on a very good day where the Dow gained 337 points, S&P jumped 1.23%, NASDAQ pole vaulted 1.86%. Let's talk about the potential impact of the upcoming quarters from Alphabet, Microsoft, Meta Wednesday, Amazon, and Apple Thursday. Multi-trillion dollars all. First, these stocks plus Tesla and NVIDIA account for almost 35% of the S&P 500. Now, that's what matters. Each of them is equal to dozens of other companies, and by virtue of their breadth of products, they represent the best we have in this country and in the world. They deserve their status. I can make a case to own every one of them, no matter what they say this week, because they are that special. Although you can't own all of them at the same time in a diversified portfolio. This group is like Murderer's Row, the stock version of the 27 Yankees. It's an extraordinary lineup. Second, we know that the market's direction for the next couple of months will be defined by the results we get this week. You cannot mount a sustained advance if you lose these companies. Nothing can make up for them. Yes, the stakes really are that high. So with those caveats out of the way, what am I expecting from the mega caps? Right? Alphabet, Microsoft, and Meta all report after the close on Wednesday. Can you imagine that? Let me stipulate that if you trade off the headlines on any one of these, you are a first-class moron, and I question your critical faculties. You have to at least wait to listen to the conference call before you do anything here. These are complicated companies. You will get them wrong. While Alphabet, Microsoft, and Meta are at their core tech companies, they've moved into multiple venues, multiple areas, multiple verticals. And that's why when I think of Alphabet, for instance, I now think of YouTube because it has that amazing business model where it makes a ton of money off ads, yet the ads somehow don't destroy the user experience, even for the NFL. I want to see expanded hours, expanded ads. Google search was supposed to be cannibalized by Gemini. Alphabet's AI platform? No. Turned out to be the two great tastes that taste great together. Shocked me. I talk about in my book, I talk about how I screwed this up. I didn't believe that could happen, but it is that strong. Sometimes it's good to have a little humility in how to make money in any market. The ad basis on Google, it's tremendous. I mean, it's just so good. The most important business, though, believe it or not, is not the ads. At least from the point of view of Wall Street, that's what we're talking about tonight, is Google Cloud, which has been on fire. Today, Google announced a deal with NextEra Energy to restart a nuclear plant in Iowa, because their data centers are desperate for electricity. Of course, reopening a decommissioned nuke plant doesn't solve the problem anytime soon. It won't be ready until 2029. When these plants are decommissioned, they're not meant to be recommissioned. They're scuttled, for heaven's sake. But Google has so much more business than they can handle, they got to do it. I call that a high-quality problem.
House of pleasure.
If they spend any time talking about their quantum computing business, that will be worth 10 easy points. Quantum. Second is Meta Platforms. Now, we need to hear all sorts of metrics like family daily active people and family average revenue per person. I know it sounds silly, but last quarter's DAP, yes, they call it DAP, was $3.48 billion. I think Meta's bumping up against that $8 billion person limit because that's all the people we have on the planet. Not even Zuckerberg can top that one. You can't create people. We're looking for $14 for average revenue per person. DAP and ARP. Yeah, they determine the direction. As long as expenses are under control, and they will be. What do I want to hear? I want to hear an upbeat, stern Zuckerberg who talks about his competitive advantage in AI and power. It would be tremendous if he talked about how small to medium-sized businesses have abandoned all other ways of advertising except his company. And maybe two others that he doesn't have to mention. It would be amazing if he talked about how the Meta glasses, the new black ones that we saw, the Rene Haas ad from ARM, are a great way to convey artificial intelligence, and they're actually a needle mover now. No longer a curiosity. All right, Microsoft's in a tough spot. It's basically become an enterprise monopolist. And even with this business-friendly White House, it's still not good to be talking about being a monopolist. What are we looking for? All right, we care about Azure, Microsoft's web services equivalent, doing at least 37.5% growth in constant currency year over year. If Azure grows at 40%, this $531 change stock will take out its all-time high of $555. What's on my personal wish list? I want fat fabulous CFO Amy Hood to do cartwheels and say they're crushing it. She'll never do that, though. Amazon's an amazing company. Retail is terrific. Prime's great. They're fixing Alexa. Love the video. But all that matters this week is Amazon Web Services growth rate. It was growing at 17.5% last quarter. I know, much slower than Azure, but it's also much bigger. People are buzzing about that number reaccelerating. I think we need to see at least 20%. 20% growth, and we need a real positive outlook from the company. No more meandering, no more musing, just positive. That could cause this, the poorest performing Mag 7 of late, to break out to the upside. Stern positive. We're also beginning to hear about big corporate layoffs at the company. Good for earnings, but it doesn't matter at all. The quarter's all AWS all the time. My wish list. I want to hear that Amazon's working with NVIDIA to develop new chips that can help Amazon Web Services attract a host of new companies that would have otherwise gone elsewhere. I'm not talking about new young companies what need to write. We also need to hear that the big outage didn't hurt them. I'd like that. Finally, there's Apple. I care about the reception of the iPhone 17. If they say it's terrific in each major country, that's a home run. If they see an acceleration in China and the U.S., the stock takes out much more than its high. If they talk about an acceleration in service revenue, the stock rallies some more. Let's see. I'll tell you exactly what's going to happen here. The stock went out today at the high. It went out at $268. Went to $269. This stock goes to $280 if it says what I just said. It goes to $300 if they talk about accelerated growth rate around the world. Now, what I'm really hoping to hear, and this is the secret to 300, many of the hyperscalers want to pay Apple to become their default AI system, not unlike the deal Apple has with Google, where Google pays them more than $20 billion to be preferred search system. Except this time, I'm expecting the winning bidder to pay a lot more than $20 billion. It would be incredible to hear about an auction to become the AI provider. Apple doesn't have to pay any money, and they get it all. Gross margins would be extraordinary. We might even be willing to overlook sales in Shanghai. Now, I know it sounds like I am being facetious here. These companies are gigantic. They have many divisions. They're filled with brilliant people. I love them. But Wall Streeters are by nature Lilliputians with teeny tiny minds who are fickle and pick ridiculous metrics to determine the direction of these trillion-dollar monsters. They decide that Amazon Web Services has to accelerate, rather than whether Amazon's being a great company saving money with AI. They decide that Meta needs to have low power costs, or that Apple has to show us that the 17 Pro is doing better than we thought, or the CFO has to be boisterous at Microsoft. It's all revolting to me. But that's what people need to hear. That's what this week's about. The bottom line, is this ridiculous? Of course. But I don't make the rules. I just play by them. I'm going to John in Hawaii. John.
Hey, Jim, a big aloha from Honolulu, Hawaii.
As I always say to you, John, mahalo. What's shaking, partner?
Hey, tell you what, thanks for your education, Jim. I've beaten the S&P for the last 12 years running. And
that's what I want to hear. Yeah, I don't know, John. He said that stuff. That's fantastic.
Tell you what, I'm calling in on one that's had monster gains this year, and that's Arista Networks, ANET.
Don't touch Arista. Don't touch Arista. That one, that's a beast. That's a beast that's going higher. $200 billion. Jay Sri Lalal. I don't talk enough about what an amazing CEO she is. That stock goes higher. Let's go to Chris in Illinois. Chris.
Booyah, Jim.
Booyah,
so I
Chris.
wanted to ask you about Kava Group. I love that they are profitable. I love the strong balance sheet. And then over the weekend, I get to Chapter 17 of your new book where you highlight the company's strong growth potential.
I sure do. I put Kava in the magic circle. I think you got to buy the stock at 62. It's down 44%. I picked it. It was going down when I picked it for the book. And I just said there's going to be someone that's going to come out of the scrum and be like maybe the next Chipotle from before the decline. I think it's going to be them. Oh, my God. I cannot believe it. The famous Bo Nix from South Dakota is called him North Dakota. Bo.
Uncle Jimmy Chill. How you doing today, sir?
I am doing well. How about you?
Not too bad.
Excellent.
Got a question from your nephew here. TKO, with the acquisition of UFC and WWE, are they a own it or trade it stock?
No, you can own that stock. That's a very, very good company. I would have thought they'd give me a couple of thousand, 100,000 shares because I work with them. But I haven't seen it yet. I got to check maybe it's in the snail mail, But anyway, you got a good one there, Bo. All right, Bo knows. All right, look, Wall Street will hold the Magnificent Seven to a ridiculously high standard this weekend. You got to know the rules of the road before you make a decision. I just gave them all to you, believe it or not. That was true. I'm out tonight. crazy to believe, but there are now 10 U.S. companies with a market cap north of $1 trillion. So which company could be the next to join that hallowed list? I'm sizing up the situation. Then, amid a flurry of earnings, we get some positive reactions in the automaker sector. I got to detail how Ford and GM managed to pull it all off. And it seems like every day, right, we're hitting new high after new high after new high after new high. What do the charts tell us about the momentum of this market? I'm consulting the technicals for the answer, so I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
I can remember 7 years ago when Apple became the world's first trillion-dollar company. Now there are 10 of them that trade in the United States. NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and then the smaller Broadcom, Taiwan Semi, Tesla, and Berkshire Hathaway. These aren't the only trillionaires. Saudi Aramco is worth $1.66 trillion, but that's a state-owned business, not one that trades here. Tonight, though, I don't want to focus on the already existing trillionaires. We know what they do, right? Instead, you know what I'm going to do? I want to search for the next trillionaire. Turns out there are not a ton of competitors here. Only 6 American companies have market capitalizations between $500 billion and $1 trillion. There's also one Chinese company, Tencent, but its shares aren't traded here. So let's look at the 6 closest U.S. contenders that could possibly become the next members of the Trillionaires Club. I'm going to handicap their odds. We're going to do it just like racehorses. We're going to start with the long shots like a MasterCard, which I'm paying at 50-1 odds, as it's currently the furthest away from the finish line with a market cap of $517 billion. People always seem to be shocked when they hear how big these payments companies really are. But you know what? They keep putting up steady earnings growth with no credit risk, and their stocks keep chugging along. MasterCard's earnings have risen at a 16.8% compound annual growth rate over the past decade. This one's slow and steady, which is why I call it a long shot. I've owned it for a long time for the Chapel Trust. I shouldn't have gotten bored with it. I mean, it's just such a winner. It's a great investment. Got to be patient. Call it the 6th most likely. 5th, there's Visa, another long shot that's in the same boat. Although I give it 40-1 odds because, look, it's got a market cap already about almost $700 billion. Same story as MasterCard, though. 16% compound annual earnings growth over the past decade, 14% growth expected this year. No matter how much Wall Street worries about the new payments platforms, they never seem to make a dent in the big credit card networks. Like MasterCard, though, Visa doesn't really have the juice to leapfrog its more richly valued competitors in the trillion-dollar race. But, man, this stock's given shareholders an annual equivalent gain of about 17% for the past decade. If they keep it up, Visa should be a trillionaire within 3 years. And I bet Visa gets there. I just doubt they'll get there first. Now, let's talk about the real contenders, okay? Let's start with Eli Lilly, one I always said was going to get the $1 trillion, but it's really stumbled here. It's in 4th. I'm going to give it 15-1 odds now. Market cap of $780 billion, the most valuable healthcare company in the world. Lilly's grown by leaps and bounds over the past few years thanks to its revolutionary GLP-1 drug that's known as Mounjaro for diabetes, but Zepbound for weight loss. It even got pretty darn close to trillionaire status last year, with its market cap peaking at $912 billion in the summer of 2024, where I thought it was going to go over. I was wrong. But the stock's been choppy since then. We own it for the trust. Some of that's because Lilly's had to digest its gains. Some of it's from worries about competition. Both from Novo Nordisk, that's the maker of Ozempic, slashing prices, and from other drug companies who are working on similar products. Every time the news comes out, the stock gets hit. Some of it's due to potential regulatory headwinds, too. President Trump likes to talk about cracking down on high drug prices, although how far he'll actually go, anybody's guess. As I mentioned, we own Lilly for the Chapel Trust, and I've been saying the stock needs some kind of catalyst to get things going. You know what? Maybe the FDA has to approve a GLP drug for a new indication, right? Maybe some progress in the pill form, because people don't like to take the shot. Until that happens, I'm putting Lilly's odds of winning the $1 trillion rate, winning the race to $1 trillion at 15-1. Let's see if they come up and surprise us with something on Thursday morning. 3rd, there's Walmart. Now, currently, this is the closest company to the $1 trillion level. It's $833 billion market cap. I'm putting its odds at 10 to 1. Well, I love Walmart. I love to shop there. I'm only making it my third favorite in this race because the stock's had an incredible run. And get this, it's trading at around 40 times earnings. That's very high for any retailer, save Costco. Even Amazon only trades at 34 times this year's earnings. Of course, Walmart's made some major improvements, and the company's massive scale allows it to cope with the tariffs better than nearly all of its competitors. But the stock, it's just not cheap. My number 2 favorite is Oracle at 4 to 1. Current market cap, just over $800 billion. If I were making these odds based solely on momentum, Oracle would be the overwhelming favorite to be the next trillionaire, as it's ridden the AI data center wave to achieve tremendous gains. This stock is up 274% over the past 3 years, including a 69% gain year to date. A big chunk of that comes just since Oracle announced a massive cloud deal with OpenAI last month. If the stock can keep up its recent momentum, then I think it would hit the $1 trillion finish line pretty darn soon. But I don't have Oracle as the absolute favorite, frankly, because I think there should be some recognition of the risk that these guys are taking. At this point, basically all of the major players in the AI data center trade, from NVIDIA to Broadcom to AMD to CoreWeave, are taking a risk in that they're assuming OpenAI will be good for the massive amounts of money it's committed to spending. And no one has more exposure to that than Oracle, which is expecting to get $60 billion per year from OpenAI in their 5-year deal. Wow. Everyone in the industry seems to think OpenAI will be good for the money, but no one needs them to be good for it like Oracle does. So what's my number 1 favorite? JP Morgan Chase, the nation's largest bank, at the $832 billion market cap. I think it's going to be the first to $1 trillion. JP Morgan is incredibly well run. America's top banker, Jamie Dimon, at the helm. Its fortress balance sheet allows the company to consolidate in times of stress, like they did during the mini banking crisis 2 years ago, where they came out the winner. But the reason I have JP Morgan as the favorite in this race with 3 to 1 odds is very simple. The banks are on fire right now, and right now this stock is ridiculously cheap. This thing trades at 15 times this year's earnings estimates. Who said that every stock's expensive in this market? If we get a little multiple expansion and people say they start paying on 17.5 times next year's earnings estimates, then JP Morgan wins this race in a heartbeat. Could the next $1 trillion company come from outside of this 6? Crazier things have happened. OpenAI is reportedly worth $500 billion in private financing rounds, but if they come public and they get that valuation, then Oracle will almost certainly be worth $1 trillion. Palantir is lurking at the $400 billion, but don't let. The stock trades at 300 times this year's earnings estimates. Why couldn't it trade at 500? I mean, once you're up there, why not? You know what I mean? AMD is sitting at $410 billion. Amazing that we can even put it in the $1 trillion camp, but I like to muse about it. But the bottom line, I think the next trillionaire will likely be one of the 6 companies that are closest to the finish line: JP Morgan, Oracle, Walmart, Eli Lilly, Visa, and MasterCard, and I'm putting them in that order. Mad Money's back after the break.
Coming up, is it time to start your engine or hit the brakes? Cramer's digging into the latest earnings from Ford and GM and seeing if these stocks get the green light to buy. Next.
Last week, we got what might be the biggest surprise of the entire earnings season, when General Motors and Ford both saw their stocks rally like crazy. Buy. I got to walk you through what happened here, because basically hardly anyone saw this coming. Remember, the automakers were all supposed to be crushed by tariffs, a weak consumer, a lack of demand for electric vehicles. But that's not how it played out. Let's take them in chronological order, starting with GM, which reported last Tuesday morning. In response, its stock jumped nearly 15% in a single session, making it their second best day since the company emerged from bankruptcy in 2009. GM finished the week up almost 20%. The stock kept making new 52-week highs. For GM, the story actually starts a week before the formal earnings report on October 14th, when the company announced that it would be taking a $1.6 billion charge from its electric vehicle business. Basically, they'd overinvested in electric vehicles, and now that some of the tax incentives had expired, demand for these cars just isn't there. That announcement did a great job of lowering expectations into the earnings report. So when GM reported last Tuesday, it shocked Wall Street with a huge top and bottom line beat. The revenues came in at $48.6 billion. Analysts were only looking for $45 billion. They earned $2.80. Wall Street's looking for $2.29. GM also raised most of its full-year guidance, taking its adjusted earnings forecast from $8.25 to $10 range to $9.75 to $10.50 range. That's a big move. In the United States, GM said that they achieved their highest third-quarter market share since 2017, thanks to their industry-leading full-size pickup and SUV franchise, as well as record crossover deliveries. Even though they're pulling back on electric vehicles, Chevy's now the number 2 EV brand in America. Plus, GM's also started to get meaningful contributions from their self-driving Super Cruise technology, as well as OnStar and other software and services business it's coming together, GM. Now, GM's bread and butter North American business was still down substantially year over year, thanks to a big margin decline. But GM International is cleaning up. Even the previously challenged Chinese business helped make up the decline in North America. That said, management was pretty optimistic about their ability to improve profitability in North America, especially now that they're pulling back on electric vehicles. On the plus side, management said they're expecting less of a tariff hit this year. They're now saying that the impact will be $3.5 to $4.5 billion. That's down from $4 to $5 billion in their previous forecast. On the conference call, CEO Mary Barra thanked President Trump for slapping tariffs on medium and heavy-duty trucks, protecting GM from competition, while giving them some offsets to deal with tariffs on imported car parts. No business ever got hurt by staying in the White House's good graces. Hey, look, even after the monster run, I think the future looks really great for GM, especially if the Federal Reserve cuts rates again this weekend. I think they're going to. Next up, how about Ford Motor? With Ford, the big story coming into the quarter was a fire at one of their key aluminum suppliers, Novelis, which threatened to cut its company's production and therefore its earnings power. Management had been cagey about how much damage this would do, but last Thursday night, we finally got an estimate of the impact of the Novelis fire, and let's be clear, it's big. Ford said it expects $1.5 billion to $2 billion impact to earnings for interest and taxes this year, or EBIT, from the Novelis-related disruptions. And the company lowered its full-year EBIT forecast to $6.5 billion, down from $6.5 to $7.5 billion previously. And that's why initially, the stock got slammed. But then, though, Ford bounced back almost immediately. A lot of people were confused by this, and it only finished Friday session up 12%. Because investors realized a couple of things. Let's go over them. First, look at these numbers. Management expects at the midpoint of its estimate $1.75 billion hit to EBITDA, okay, from the Novelis fire, from EBIT, not EBITDA. But it lowered its full-year adjusted EBIT outlook by just $750 million at the midpoint. So let's think about this. Excluding the fire, Ford was actually taking up numbers. That was confusing initially, but wow. On top of that, Ford said they expect to see an additional benefit of $1 billion in EBIT next year because of production delays related to the fire. Basically, some of their sales are being pushed out into next year. So overall, across 2025 and 2026, they expect an impact of $1 billion or less, which is much less bad than many investors were expecting. It also helped that Ford delivered some great numbers for the third quarter itself. Total revenue was a record $50.5 billion, up 9% year over year, and about $3.5 billion above what Wall Street was looking for. Earnings per share came in at 45 cents, down 8% year over year, but 10 cents higher than expected. Like GM, Ford saw some strong performance in trucks and SUVs. Its F-Series is on track to be America's best-selling truck for 49 consecutive years. There's a record for you. How about this? The Bronco, which my daughter has, and they're really cool, had another record quarter and now has 30% market share in this category. The Expedition, their huge full-size SUV, had its best third-quarter performance in 2 decades. Even the Lincoln Navigator's doing well with its fastest sales pace since 2007. Hey, look, listen, put this all together, and you can understand why Ford's internal combustion business crushed the estimates. Their commercial business, Ford Pro, also made a killing. Only electric business disappointed, but again, that's the smallest part of the company by far. Also, like GM, Ford said that it now expects less of a hit from the tariffs this year. Previously, they were talking about $2 billion. Now they're saying it's $1 billion. Beyond that, management continues to expect another $1 billion in cost savings from the Ford Plus initiative. Put it all together, and it was just a fantastic week for the automakers. GM and Ford. That said, a lot of this strength is because quarters were much better than feared, as opposed to just blowout, all right? But Wall Street had a lot of worries for both Ford and GM. And it turned out things weren't that bad, and that's okay when you have low price earnings multiples like we have here. More importantly, I think both stocks can keep running. Even after these moves, GM sells for 7 times this year's earnings estimate, 6 times next year's earnings estimate. Come on. Ford at north of 12 this year's estimates, but only under 10 next year's numbers. Both stocks look very cheap, and if the Fed keeps cutting interest rates, lowering the cost of auto loans, these stocks should keep running. I think Ford CEO Jim Farley is in the catbird seat. He's taking down expectations big time. He's got a really hot lineup where I expect maybe multiple upside surprises. And now it matters that it's a hot lineup, even if they don't have a solution to the Novelis fire problem yet. That said, if the labor market keeps deteriorating, well, that's going to make it tough, obviously. And you still need to watch tariffs here, too. The domestic automakers have caught some brakes on the tariff front recently. But we know that the president's trade policy can change on a dime, right? But look, let's understand the bottom line here. Ford and GM are doing much, much better than we thought. And as long as the Fed keeps cutting rates, I think these stocks continue to run. Jim, in my home state of New Jersey. Jim!
Hey, the Messiah of money. How you doing this afternoon?
Man, I'm liking that nomenclature. How can I help you?
You made me. I'm sitting here. I just finished my steak dinner because of you, buddy. Listen.
Holy cow! You ate a little early, but that's great. What you have? What kind you have?
That's what I do. Well, I'm old, But listen, I had the fever like Christopher Walken on this stock, and I bought into it when everybody had the EV fever, and I wrote it down and averaged it out to $34 a share. I got 1,000 shares of this thing, and I can't ride it anywhere. Do I stay in it and it'll break even? I'm 50% lost in it. That's Rivian, the EV maker, and they just expanded in Georgia. What do I do, brother?
Sell. I'm sorry. I mean, look, I want you to continue to be able to have steak dinner. I don't want you to chop sirloin. When I was growing up, I said, Ma, everyone's having steak. Why are there some little crinkles in it? It says it's better. I don't want you to say it's better. It's not. You're selling it. The worst fears for investors in GM and Ford have not materialized, leading to the big moves that we got. I think you know what? I think this run is not over. Boy, we have a lot of mad money ahead. And let's see, what do we have? Okay, is there a turnaround in sight in the healthcare sector? That'd be a shocker, huh? Then close viewers know that I've coined this year as the year of magical investing. And that actually means it's critical, but that's okay. I'll get another lift today, and I'll reveal it. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. This market just keeps on chugging along, doesn't it? Hitting new highs today as we learn that the White House might be close to reaching a deal in the trade talks with China. Even though there are countless commentators who seem to fear and loathe this market, that hasn't been able to stop us from rallying. So can stocks really keep running like this? I mean, to answer this question, we got to go off the charts, and we're going to do it with Jessica Inskip, first woman on the active trader desk at Fidelity, now director of investor research at stockbrokers.com, as well as the co-host and founder of her Market Maker podcast. I suggest you listen to it. Excellent. She's got a terrific track record, especially this year on the show. Holy cow. A month ago, when a lot of people wanted to give up on the bull, what did she tell us to do? Stick with it, insisting that the bull still had legs. Looking back, what a phenomenal call that was. And you know what? Inskip's still bullish. She thinks this market's got room to run. Why? Okay, first I want you to take a look at the weekly chart of the S&P 500. As Inskip sees it, the S&P's been in a long-term secular bull market, and it is intact, okay? She likes to look at the 13-week, and this is how you check these, 13-week, okay, 26-week, and the 40-week. Those are great averages. She thinks they represent 1, 2, and 3 quarters, respectively. True. Remember, the quarter is still the most basic unit of time in the business world. Is what we look at. Right now, these 3 moving averages are all sloping upwards and acting as floors of support underneath the S&P, which tells Inskip that the index remains in a bullish trading cycle. As long as the S&P remains above its 13-week moving average, so then you take a look at the red, then you see where this is, and you see it's above it, okay? Well, that's at 6,546. That's down more than 300 points from here. She thinks we're still in good shape. So in other words, it's got to stay up here. Now, it gets a little more granular. If that level does break down, Inskip points out to the 26-week moving average, okay? That's a 6,287. Can't really see it right in there, but it's right in there. And then there's another key floor of support at 6147. That's the key one. Okay, that's what you need to worry about. And that's where the S&P peaked on February 19th for the trade turmoil through the market into chaos. We've got to stay above that. A month ago, Inskip told us to watch the Bollinger Bands, okay? These are the purple lines above and below the price. Okay, see those? And they represent the current level of volatility. At the time, these bands were narrowing, and they kept narrowing. Now, Inskip's watching for the S&P to remain closer to the upper Bollinger Bands. There, okay? She's also watching the RSI, the Relative Strength Index, okay? This is an important momentum indicator. It can tell you when something's gotten overbought or oversold. A lot of technicians will say that anytime the RSI goes above 70, here's 100, you can see where we are, it's overbought. Right now, the S&P started to bump up against 70, but Inskip says it's a little more complicated than that. When the RSI reaches higher highs, the underlying security needs to do the same. That tells you that the price hasn't moved up too far, too fast. Right now, the RSI's got a very bullish reading, and the S&P keeps making new highs. So Inskip says we don't need to worry as much about the index getting overbought here. But if the relative strength index pulls back, then she'd expect a harsh sell-off. So far, so good. Okay. Now, she likes to do something besides just look at the big caps. I want you to take a look at the weekly chart of the S&P equal weight. Okay. This is the S&P 500, except every single stock counts the same, as opposed to the regular S&P, which is weighed by market capitalization. In the normal S&P, Magnificent 7 account for 35% of the entire index. In this, the S&P equal weight, the Magnificent 7 make up less than 1.5% of the index. Basically, we like to watch the S&P equal weight because it gives you a better sense of the real economy as opposed to the data center economy that I keep talking about. And right now, the S&P equal weight's doing pretty darn well. Inskip points out that the previous ceiling of resistance has become the new floor of support, 7612. Again, just like we had that green line before, this is the crucial level, all right? This is where the index made a higher high in November of last year. The regular S&P 500 blew through its November highs in June. The S&P equal weight caught up in mid-August. As long as the S&P equal weight remains above this level, Inskip says the rally can keep broadening. And that's what this chart really measures, breadth. Next, let's take a look at a down and out sector. Let's look at healthcare. All right, specifically the weekly chart of the healthcare select spider SPDR. The XLV is the stock symbol. The last 12 months have been pretty brutal for healthcare, but Inskip thinks this group has finally found its footing and might be due for a breakout to the upside. Why? All right, for starters, the 13-week, 26-week, and 40-week moving averages, remember those that I just showed you before, they are sloping upwards, okay? So you can see right here starting to slope upwards, particularly the 13-week. And that those are floors of support underneath the XLV. Again, that makes for a bullish trading cycle. At the same time, the healthcare ETF has been hugging the upper Bollinger Band. Okay, there's your upper Bollinger Band right here. And that tells Inskip that the trend remains strong. On top of that, the 13-week moving average recently crossed above the 40-week. There's a MACD crossover. That's a textbook bullish crossover. People just say that of all the most, I would say of the things that are most predictable, it's an upside move after a bullish crossover right there. After spending the better part of a year lost in the wilderness, the healthcare sector has been on the rise ever since it bottomed in August. Given that this has been one of the weakest areas of the market, the turnaround in healthcare fixes a major chink in the SP 500 armor that many were worried about. That said, Inskip points out that the key 13-week, 26-week, and 40-week moving averages have begun to flatten out, and you can see that. That signals consolidation and the possibility of a trend shift. However, how about this? She thinks it might be a positive trend shift. So the XLV managed to break through the Ichimoku cloud, specifically this dark purple area on the chart. This is a technical tool that combines a bunch of moving averages to give you one glance reading on the situation. You just talk about a lot on the show. That purple area had been a major ceiling of resistance. It's now become a major support. Wow, this thing could really be charged. If this goes up, I'll tell you, the bears are really going to just be crushed. What else? The XLV's relative strength index has b43 trending upwards. Look at this. Which tells Inskip that healthcare is headed in the right direction. Next ceiling of resistance comes at 148.35, which is around where the healthcare ETF peaked in early March. And here we go. Okay. Inskip says this is a major hurdle for the XLV, and if it can clear this hurdle, she expects the healthcare sector to soar. So you can imagine, get some healthcare if that happens. Here's the bottom line. The charts interpreted by Jessica Gibbons suggest the S&P 500 still got room to run, and judging by the action in the S&P equal weight, she expects the bull market to keep broadening. Even the despised healthcare sector's got a new lease on life. Makes me think of CVS, maybe United Health, maybe McKesson, maybe a Merck. Sounds like they're all ready for a breakout. Mad Money's back after the break. Time for the White Round Quick Win Best for Robert Cole. What's the same? The stock tender buy, sell, just figure no calls ahead of time. I step first to grab so far. You play this sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the White Round Quick Win. Let's start with Randall in Alabama. Randall.
A big Bama booyah, Cramer.
Roll Tide. What's up?
Roll Tide. I'm calling about my spec stock that's up over 300% year to date, 85% year-over-year revenue growth. To close 2 multi-year, multi-billion-dollar contracts is in talks with 3 other hyperscalers. My spec stock is Applied Digital, APLD.
Oh, this thing's hot as a pistol, and it does have a lot of great customers. Amazing leasing. I'm going to bless it. I would normally not bless it, but it does have the contracts. It really does. Let's go to Tom in New York. Tom.
Good evening, Jim.
Hi, Tom.
Thanks for taking my call.
Okay.
Jim, I want to know why you're complaining. Like Josh Brown calls you a legend. That's pretty good.
No, it was great. And I had such a great time with Josh on Friday. That was some show. He really is just a fantastic guy. And I'll tell you, the clients, whatever you want to call them, the fans, whatever, they are dynamite. I just love that show. Thank you.
Yeah. Okay. Jim, I'm calling you about a company that you had on last November, and I put them on my watch list, and they were up at a high over 44 in July, and then they dropped down some. So I started a small position, and then they kind of went to earnings and fell off a cliff. I don't know. I'm wanting to know your advice on Kyndryl Holdings, KD.
Yeah, the last quarter was not that good, but Martin Schroeder's going to right that ship. I think you're buying an inexpensive consulting company right there. Really very good IT work. I think I would not buy more right here. I would buy some and then wait to see what the quarter is to see they don't have another bad quarter. And I don't mean to say bad. I mean less than expected, okay? Let's go to Lisa in Florida. Lisa.
Hello. Hi, Jim Cramer. Booyah.
Oh, hi, Lisa. Booyah back.
My question to you is on SMCI, Super Micro.
Yeah, I know they keep saying things are great, but I'm going to tell you something. I want you to sell that stock, and I want you to buy the stock of Dell right here tomorrow morning, okay? Buy Dell, sell SMCI. I'm going to Joanna now in Pennsylvania. Joanna.
Hello, Mr. Cramer. Thank you for taking my call.
Oh, well, you're welcome. What's up?
I have a stock that's making me crazy. TeraWulf.
Okay. Yeah, well, this isn't. No, look, if you want to have Bitcoin, the amazing thing about Bitcoin is you buy Bitcoin. I want you to sell TeraWulf. Now, look, the shorts could run it in my face, and there's a big short position, 31%, and it could go up. But I don't have any conviction, so I can't tell you to buy it. Let's go to Ben in Tennessee. Ben.
Hey, Jim. Thank you for taking my call, buddy. I really appreciate it.
You bet.
I'm calling about a cybersecurity company that recently went public, Netscope, NTSA.
Yeah, look, there's 2 cybersecurity companies. There's CrowdStrike and there's Palo Alto. And then there's just everybody else. And we're going with CrowdStrike. We're going Palo Alto. Let's go to Jeff in California. Jeff.
Booyah, Professor Cramer. How are you?
Partner? I am good. How about you?
Good. I'm Jeff from Walnut Creek, California. I've been watching Mad Money for 20 years and a founding club member.
Oh, fantastic. Thank you very much. Thank you for being a member of the club. What's up?
Good. I was in your neck of the woods in the Reservoir Tavern in Boonton, New Jersey last week, and they have a framed photo of you. They have a framed photo of you. Yeah, framed photo of you.
I love that place. I love that place. I went there with Haley and Beebs. Amazing. It was just so much fun. How can I help?
I know. The question I have is on the stock ThreadUp. I purchased it about a few thousand shares back in May of this year. Held it for 2 months, made a nice profit, sold it at $6.07.
I got to tell you, ThreadUp is one that eluded me. I'm going to have to go to Professor Ben Stoto, who I know knows ThreadUp like the back of his hand, and we're going to get right to the basis of that one. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
The year of magical investing continues. As always, it's led by Palantir, the superintelligence/AI/defense company, with a stock that's blown through all my previous price targets is now within striking distance of $200 after its more than 2% move higher today. The Messianic CEO, Alex Karp, has the growth, the profits, and the fan base. I'm tempted to raise my $200 price target to $250 right here, right now. But it might be better to save the hyperbole until Palantir actually takes out $200. You have to be impressed at the level of early morning buying in this stock. The buyers like to take it up 3 or 4 points about 2 hours before the bell rings. There seems to be no natural sellers anywhere, any single day of the week, just shorts that are easily extinguished. Today, though, another highly elevated stock stole the show, and that's Qualcomm, which announced that it's going to produce a new chip for artificial intelligence hardware, something that can compete with NVIDIA and AMD, it says. Qualcomm says this chip will be ready next year, and it's already got Humane as a client. That's the Saudi AI company backed by its sovereign wealth fund that wants to become a power in data centers. Qualcomm's chips are focused on the inference portion of the AI food chain, the contracts for 200 megawatts. Now, Qualcomm's not alone. NVIDIA's already into Humane for 500 megawatts, but 200 is a much bigger deal for Qualcomm than it is for NVIDIA, hence why it's rallied more than 11% today. I get it. Ever since AMD said it was going up against NVIDIA, that stock has rallied nearly 100 points. Who want to miss the next AMD? So why not just buy the stock of Qualcomm? My problems are twofold. First, Qualcomm is a boastful company. I don't want to say any more about that. Second, the action in Qualcomm today reminds me of the action in Qualcomm in 1999, when that stock advanced 2,600%, only to experience one of the worst collapses of the entire dot-com era. It's the ghost of Qualcomm bull markets past. It's a very different company now than it was 25 years ago, but I do not like the parallel. Perhaps the most worrisome, though, is the fact that all the semiconductor stocks have been up at the opening off a possible Chinese deal, but then reversed hard when the Qualcomm news broke. That's a telltale sign of the dot-com era, where there was this pool of hot money that would plow into a stock until some other company then had good news, then it would swap out of that stock and into the second stock. We saw this over and over and over again. Not a lot of new money in, just furious rotating, chasing one huge press release after another. And there are plenty of other signs of froth. Quantum computing stocks came roaring back today. People betting that the U.S. government still might subsidize them to stay ahead of China. And what NASDAQ party would be without Tesla? Today, the stock rallied on robots and self-driving cars as the narrative continues to move away from car sales in general. Of course, Elon Musk's pay package vote got in the way. I wouldn't worry about it. But I am worried about what's happening right here, right now. I've been a big believer that the AI movement, the so-called fourth industrial revolution, is still in the early innings. Compared to the dot-com era, I'd say AI is still in the mid-90s. In the dot-com era, you made a fortune from the mid-90s through the beginning of the year 2000, at which point you did have to sell everything to avoid one of the worst bear markets in history. As someone who's been bullish on this entire move, I don't want to be caught up in 1999 again, but I can't be oblivious to what I see happening on a daily basis. This extraordinary move on just a press release from Qualcomm really jarred me. I know there'll be more competitors to NVIDIA. I know Qualcomm has a history of developing lower cost and lower powered chips, which is exactly what the data center needs. If Qualcomm can do it, then why not ARM Holdings issue a press release? Why not Intel? Why not anyone? And that's what this market seems to be saying. We're advancing past the bold to the ridiculous with this Qualcomm move, just like 1999. When you can put out a press release about a new client, your stock shoots up more than 11%. And by the way, at one point it was up much more than that. Then I question the judgment of the buyers, and I question the judgment of the entire market. We need to throw water on the fire of froth, not gasoline. I like to say there's always bull market summer. I promise I'll find it just for you right here in Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.